Before we begin, please support the channel by subscribing, liking, and sharing this explainer. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. All right, let's get right into it. Today, we are walking through the U.S. market peripheral notes for Wednesday, April 8th, 2026. And just so we're all on the same page, this video presents a direct informational narration of the source document. And of course, the important notice up front. This document is for informational and research purposes only and does not constitute investment advice. Remember, investing always involves significant risk. We've got a lot to cover. First, we'll look at the geopolitical situation with the Middle East ceasefire. Then, we'll see how that's rippling through the energy and chemical sectors. After that, we'll pan out to the broader market index and sentiment, dive into monetary policy and inflation, check out some interesting sector highlights with Intel and Delta, and then we'll wrap it all up with the technical outlook and what risks to watch for. So let's kick things off with Section 1, Geopolitics. We're talking about the ceasefire in the Middle East and something the source is calling the rent extraction of the Strait of Hormuz. So, a temporary 2-week ceasefire is on the books. And while the market jumped on that news, the reality here is, well, it's a lot more complicated. The source calls it a Schrödinger-style ceasefire. It both exists and doesn't at the same time. It's fragile. And here's the real kicker. Iran has basically used this opportunity to turn the Strait of Hormuz into its own private toll booth. This isn't just some political posturing. It's a fundamental change to the energy supply chain. You can see the real-world impact with the fact that over 800 cargo vessels are still backed up in the Persian Gulf. This table really paints a clear picture of the new normal. Let's walk through it. Daily transit volume is now capped at just over 10 vessels, but on Wednesday, only 4 actually got cleared. That means Iran has absolute power to decide who gets to pass. For booking, all fees have to be confirmed a week in advance, which basically turns freedom of navigation into a political bargaining chip. The tariff for a very large crude carrier? It can be up to $2 million. That's a straight-up hidden tax on global energy. And finally, security access has to be coordinated with Iranian armed forces, which solidifies their de facto control. So, when you see oil prices staying strong, this is why. The market is pricing in this new cost structure as permanent. Now, let's see exactly how that geopolitical pressure is playing out in the markets. That brings us to Section 2, Energy and Chemicals Analysis. So, when the ceasefire news first hit, we saw a textbook pattern in the energy markets. A sharp drop, the geopolitical premium unwind, which was then immediately followed by a strong rebound. Oil dipped toward $80 before snapping right back to trade around $90. The swings in stocks were pretty wild. You had ExxonMobil dropping 8% before clawing most of it back. And check out the fertilizer company, CF Industries. It plunged 17% before completely reversing course. What this tells us is that the market is quickly getting the message. The structural damage is done. This risk isn't just a one-off shock anymore. It's become the new pricing benchmark for everything energy-related. Okay, moving on to Section 3. Let's pull the lens back and look at the broader market. The big story here was a violent short-covering rally that slammed right into a major resistance zone. That ceasefire news was like pouring gasoline on a fire for short sellers. It forced big institutions who were betting against the market to buy back their positions. And that buying just fueled the rebound. I mean, look at the scale of this move. The S&P 500 shot up to 6793. The NASDAQ 100 ETF, the QQQ, rallied 3%. Even beaten-down sectors like travel got a huge lift, with Carnival Cruise Line surging 11%. But then, all that buying pressure just stopped, right as the index got near the 6,800 level. So why there? Well, if you look at the options data, you see a massive wall of positioning. We're talking about $10 billion in positive gamma, parked right at that level. What that means in simple terms is that as the market rises into this zone, it can actually trigger a wave of selling from dealers who have to hedge their books. It essentially turns that 6,800 to 6,840 range into a classic liquidity trap. So what's the sentiment telling us right now? Well, the VIX, which is the market's fear gauge, dropped down toward 21. But notice, it didn't break below 20. That sub-20 level is what many consider the comfort zone. So the fact that we're still above it suggests there's some caution under the surface. At the same time, the US dollar fell, which usually means money is moving out of safe havens and into riskier things like stocks. But the buying seems pretty hesitant, you know? The big institutions are clearly getting nervous above that 67.50 level. And that feeling of caution is a perfect segue into Section 4, monetary policy and inflation, because the latest Fed minutes just drew a new red line for tech stock valuations. Yeah, right when the market was feeling good about the ceasefire, the minutes from the March Fed meeting dropped and threw a bucket of cold water on the party. The signal was very hawkish. The Fed basically said that inflation's journey back to 2% is taking longer than they'd like, the risks are growing, and, this is the big one, the idea of another rate hike is officially back on the table. Now, here is the number that really matters, especially for the tech sector. The 10-year Treasury yield shot right back up toward 4.3% after those minutes came out. For those high-growth tech stocks, that 4.3% level is a critical red line. It's like a valuation kill switch in their financial models. So the core assessment here is that once this short-term excitement wears off, these macro realities are going to take back control, and that could force another painful round of valuation cuts for tech. All right, let's shift gears to our fifth section on sector highlights. Because even with this tricky backdrop, some companies are navigating it really well through some smart strategic moves. We're going to look at Intel and Delta. So on the screen, we've got two really fascinating stories. First, you have Intel, which surged an incredible 11.4%. Why? News that it's part of Musk's huge 1 terawatt semiconductor project. This is more than just a big contract. It could signal that Intel is getting back to the center of the whole AI compute race. Then on the other side, you have Delta Airlines. This was a classic good news gets sold situation. The stock gapped up almost 12% after great earnings, but then it faded all day to close up just 3.75%. That's a clear sign of institutions taking profits into strength. So why is Delta still considered resilient even after that profit taking? The source breaks it down into 3 key reasons. First, the fundamentals are solid. Those first quarter results beat expectations. Second, they're showing real discipline on the supply side, cutting capacity to deal with high fuel costs and protect their profit margins. And third, they have this amazing internal hedge. Their own oil refinery is expected to make $300 million in profit next quarter. That gives them a level of energy self-sufficiency that most of their competitors just don't have. And that brings us to our final section, the technical outlook and risk warning. The bottom line here is that what we've just seen was a rebound driven by headlines, not a true reversal based on fundamentals. So what are the key levels to watch on the chart? Well, the first line in the sand for support is right around the 6,700 level. But the real make-or-break test is the annual moving average. The index really needs to pull back to that level and then hold it to prove that this breakout is for real. If it fails and slices back below that average, then this whole week's rally could get written off as nothing more than a false bid. And looking at the next 2 to 3 days, the source is highlighting 3 major risks to keep on your radar. First, we've got CPI inflation data on Friday, and a hot number there could be the thing that shoves Treasury yields right over that 4.3% red line. Second, any trouble with that fragile ceasefire agreement could instantly sour the mood in the markets. And third, after such a quick run-up, the riskier parts of the market, like small caps, are really vulnerable to a wave of profit-taking. So the final advice from the source is pretty clear, and I'm quoting here. Blind leverage above 6,800 should be avoided. Investors are advised to remain tactically defensive and wait for the index to retest the annual moving average and confirm support before considering longer duration positioning. And to close, we will read the full professional risk disclosure. This document is provided solely for informational and research purposes and does not constitute investment advice, financial advice, trading advice, or any recommendation, solicitation, or offer to buy or sell any security or financial instrument. The author is not acting as a registered investment advisor, broker-dealer, financial planner, or fiduciary. No advisory or client relationship is created by the publication or use of this document. Investing and trading in financial markets involves substantial risk, including the possible loss of principal. Prices of equities, indices, derivatives, digital assets, and other financial instruments may fluctuate significantly and unpredictably due to market conditions, macroeconomic developments, policy changes, liquidity shifts, and unforeseen events. All market views, analyses, and discussions are provided strictly for informational and educational purposes. They do not constitute trading instructions, portfolio management guidance, or any form of guarantee regarding future performance or outcomes. Any investment or trading decision made based on this document is undertaken solely at the reader's own discretion and risk. Readers are responsible for conducting their own independent research, verification, and due diligence, and for evaluating whether any strategy or investment is appropriate in light of their personal financial situation, objectives, and risk tolerance. Past performance and historical analysis are not indicative of future results. Market conditions may change rapidly, and information contained herein may become outdated without notice.